Imagine getting paid regularly just for holding stocks in your portfolio. That's the beauty of dividend investing, one of the simplest and most reliable ways to earn passive income. Today, we're going to show you how you can start earning passive income with dividend stocks, step by step. First, let's break down what dividend stocks are. When you invest in a dividend-paying stock, you're essentially buying a share of a company. Companies that pay dividends distribute a portion of their profits to shareholders, usually on a quarterly basis. So why are dividend stocks such a popular way to earn passive income? Simple. They provide a regular, predictable stream of income, making them ideal for long-term investors looking to grow wealth without constantly trading. Step 1. Choosing the right dividend stocks is crucial for building a reliable passive income stream. You want to look for companies with a solid track record of paying dividends consistently over the years. And this is known as a company's dividend history. Let's start with dividend yield. This is the percentage of the stock price paid out as dividends each year. A healthy dividend yield is usually between 2% and 6%. Too high, and it could indicate instability. Too low, and the income won't be significant. Step 2, pay attention to the payout ratio. This is the percentage of earnings a company pays out in dividends. A company paying out 90% of its earnings might struggle to sustain that dividend during tough times. Ideally, look for a payout ratio under 60%. Step 3, understand the power of dividend growth. Dividend growth is the secret sauce for long-term passive income. Instead of just looking for companies that pay dividends now, look for those that increase their dividends over time. This is key to outpacing inflation and growing your income year after year. Step 4 is all about reinvesting those dividends. By using a dividend reinvestment plan, or DRIP, you can automatically reinvest your dividend payments to buy more shares. This creates a snowball effect where your portfolio grows faster and so do your dividend payments. Step 5, building a diversified portfolio. It's important to diversify your dividend portfolio to reduce risk. Spread your investments across different sectors like technology, healthcare, consumer goods, and utilities. This way, even if one sector underperforms, your overall income remains stable. And finally, step 6, patience is the key to success with dividend stocks. The longer you hold, the more you benefit from compounding, dividend growth, and capital appreciation. Dividend investing is a long-term game, but the rewards are worth the wait. Of course, there are risks to consider with dividend investing. Companies can cut their dividends during tough economic times, and stock prices can fluctuate. That's why it's important to research companies thoroughly and stay diversified. Now let's take our strategy up a notch. One advanced approach is focusing on dividend aristocrats and dividend kings. These are companies with a track record of increasing their dividends for 25 and 50 consecutive years. Investing in these companies adds an extra layer of reliability and long-term growth potential. Now let's discuss the trade-off between dividend yield and dividend growth. While high dividend yield stocks provide immediate income, they often lack significant growth potential. On the other hand, companies with lower dividend yields may have higher growth rates, compounding your wealth faster over time. Now let's talk about finding stocks with high dividend growth potential. These are companies that consistently increase their dividends over time, which is key to maximizing your passive income. You can use several tools and strategies to identify these stocks. Start by looking for companies with a long history of growing their dividends, often called dividend growers. Websites like Dividend.com, Seeking Alpha, and Yahoo Finance offer tools to filter stocks based on their dividend growth history. You'll want to focus on stocks that have increased dividends consistently for 10 years or more. Another key metric to watch is the dividend growth rate, DGR, which shows how fast a company has been growing its dividend over time. Look for a 5-year or 10-year dividend growth rate of at least 5%, as this indicates the company's ability to increase payouts steadily. Lastly, pay attention to companies that have strong financial health. You can't have consistent dividend growth without it. Check key financial indicators like revenue growth, earnings per share, and free cash flow to ensure the company can sustain its dividend increases long term. By using these tools and metrics, you can identify companies with strong dividend growth potential, which will help you build a robust and growing stream of passive income. For expert investors, it's essential to understand currency risk when investing in global dividend stocks. While foreign companies often offer higher yields, fluctuating exchange rates can impact your dividend income. Hedging against currency risk or investing in ADR, American Depository Receipts, can help manage this. One often overlooked factor is the tax treatment of dividend income. In the U.S., qualified dividends are taxed at a lower rate, while ordinary dividends may be subject to higher taxes. Holding dividend stocks in tax-advantaged accounts like IRAs or 401ks can significantly improve your overall returns. Advanced investors can further enhance their dividend strategy by selling covered calls on their dividend stocks. This strategy allows you to collect premiums from options buyers while holding onto your shares and collecting dividends. It's an excellent way to boost your income from stocks you already own. Want to ensure a steady monthly income from dividends? Building a dividend calendar can help. This involves selecting stocks from different companies that pay dividends on different months of the year. By carefully diversifying your holdings, you can set up a schedule where you receive dividend payouts every month. Even the best companies can face downturns, and dividend cuts are always a risk. When a company reduces its dividend, it's a sign that they're either prioritizing internal growth or struggling financially. As an expert investor, you should evaluate whether the cut is temporary or indicative of deeper issues. In some cases, it might be best to exit the position. Once you've built your dividend portfolio, it's critical to monitor and rebalance it regularly. Review your holdings to ensure they align with your income goals and make adjustments as needed. Consider reallocating to higher-performing sectors or trimming stocks that are underperforming. If you're looking for a more hands-off approach, consider dividend ETFs as an alternative to individual stocks. Dividend-focused ETFs provide instant diversification and professional management, making them ideal for those who want passive income without picking individual stocks. However, ETFs also come with expense ratios that can eat into your returns. Finding the right dividend ETFs can be a great option for those who prefer a hands-off approach. Dividend ETFs offer instant diversification, professional management, and a steady income stream. Here's how you can find the best dividend ETFs for your portfolio. Start by filtering for high-yield dividend ETFs. These ETFs typically focus on companies that pay above-average dividends. Popular options include the Vanguard High Dividend Yield ETF, VYM, and the iShares Select Dividend ETF, DVY. Next, check the expense ratio. This is the annual fee that ETF providers charge. A lower expense ratio means more of your returns stay in your pocket. Look for dividend ETFs with expense ratios under 0.3% for better long-term returns. Finally, review the dividend yield and historical performance. A solid dividend ETF will have a consistent yield and a strong track record. Tools like Morningstar's rating system can help you compare how ETFs have performed over time. By focusing on these factors, yield, expense ratio, and performance, you can easily find the best dividend ETFs to add to your portfolio and start generating passive income. Dividend investing is one of the most powerful tools for generating passive income. But to truly excel, you need to think beyond the basics. By focusing on dividend growth, managing risks like currency fluctuations and dividend cuts, and even enhancing your strategy with options, you can maximize your income while keeping your portfolio stable. As always, stay informed and keep refining your approach for long-term success. Looking for more expert strategies to grow your passive income? Subscribe to this channel. We've got plenty of videos to help you make money while you sleep. Join us and start building your financial freedom today.